previous 2-3 videos show us that how equity markets have grown over the long term. But the question that often arises is, whatever we just discussed is history. And what's the guarantee that equity will show similar growth in the future long term? How do we explain to our investors that history is going to repeat itself? That the investor who invests today will also make money in the long term like his predecessors? The answer to this question lies in the future of our country. If you believe that India will grow, then the investors' investment will also grow. And this is not just a fancy statement for your sales pitch. There is a strong base to it. We talk about growth in percentage terms. We say that the economy has grown by, let's say, 6% or 8%, etc. And what is this 6%, 8% that we talk of? This 6%, 8% is the growth rate of our GDP, our gross domestic product. And where does this GDP growth comes from? This GDP growth comes from businesses. Because GDP is the value of goods and services that these businesses produce. And so, growth of businesses results in the growth of GDP. Another point to note here about growth rate of GDP is this 6% or 8% is net of inflation. And if the inflation is at around 6 to 7%, then the nominal GDP growth or the total GDP growth will be around 13 to 14%. So when we say that the Indian economy will grow, it means that the businesses operating in India will grow. There is a direct correlation between the businesses or the companies and the economy. Another point to note here is, we just mentioned that the Indian economy has grown at around 6 to 8% in the past, meaning the total return or the nominal return has remained at around 13%. This, however, does not mean that the businesses or the equity markets will deliver a 13% nominal return. Equities in the past has delivered around 15% nominal return over the long term, as also discussed in the previous video. And there is a logic behind this 15% number, which is what we are going to discuss next. Let's understand the logic behind the 15% return number from equity markets with the help of this example. There's this shirt manufacturing company, the KBC Shirting Company. For simplicity's sake, let's assume KBC Shirting is the only business or company operating in India. Let's say in year 1, KBC Shirting produced 1000 shirts. The price per shirt is rupees 200, and hence the total revenue is rupees 2 lakh. Now, since KBC Shirting is the only business operating in India, hence this 2 lakh is the GDP of India for year 1. Now, over the year, there are more people in the country, there are more incomes, and hence the demand for shirts increase. So KBC Shirting Company's sales increase by 7% and it starts producing 1070 shirts in year 2. This 7% increase in sales is led by economic growth, and hence this 7% is the real GDP growth of India. Now, over the year, KBC Shirting Company increased the price of its shirts by 6% to rupees 212 per shirt. This 6% increase in price is the inflation rate of the country. Again, because KBC Shirting is the only company operating in India. So the total sales for KBC Shirting for year 2 comes to rupees 2,26,840, which is the GDP of India in year 2. The total growth in revenue for KBC Shirting Company over this year comes to 13.42%. This 13.42% is also the nominal GDP growth rate of India, as it includes both the real economic growth of the country as well as the impact of inflation. So on the basis of this example, this 13.42% is the total GDP growth rate of the economy. So how do we arrive at this 15% return number which we propagate amongst our clients? The 13.42% nominal GDP growth comprises the combined growth from agriculture, manufacturing and services sectors, that is the entire economy. But we are not investing in the entire economy. The equity markets comprise listed companies from manufacturing and services sectors only. Hence, the composition of markets is more refined than the entire economy. Now, we are not investing in the equity markets also. We are investing in mutual funds. A mutual fund has a fund manager who is experienced. This fund manager has an entire research team. The fund manager and the team carefully pick the best businesses from the universe of listed businesses. So the portfolio that your investor will invest in is the result of extensive research and considerable groundwork. So for all these efforts that go into stock selection, you can easily give a margin of 2% to mutual funds for their quality. And that is how we arrive at the 15% number. Around 13% nominal growth rate of the economy plus 2% for quality gives you 15%. Now, having said all of this, how do we know that the businesses or the economy will continue to grow? And so, will the money invested by the investors in those businesses? What makes us so confident that India's GDP will continue to grow at 7 to 8% in the future also? And our next topic concentrates on just this. Why will the businesses grow? Why will the economy grow? How the growth prospects of Indian businesses or equity is bright, which in fact is the sole reason for investing in equity. Thank you.